All right, let's get straight to it. We've got crypto contagion spilling over into equities, right as we're heading into a massive wall of event risk. Here is the plan for Tuesday, November 18th. So let's put a number on this risk. We're talking about a $1.1 trillion loss in total crypto market cap, and that's just over the last 41 days. This isn't a dip, this is a significant deleveraging event that's now in play.
Look, this is no longer some isolated crypto problem. The risk has been activated. We've got forced liquidations pushing Bitcoin right through that key psychological $100,000 support level. This is now a direct threat to broader equity sentiment, period.
Okay, let's break down the key drivers for today's session.
Three things are really defining the tape this morning. First, you've got this sticky volatility. The VIX is just refusing to break down, holding firm above that 20 to 21 level. That's pure anxiety pricing in the run-up to Nvidia's earnings. Second, Fed's odds have completely flipped. We went from expecting rate cuts to now pricing at a 53% chance of a pause in December. That makes every single data point absolutely critical. And third, you have the direct fallout from the Bitcoin collapse, which is hammering related stocks like Coinbase.
But there's always a but, right? We have a major counter signal to all this risk-off noise. Reports are out that Warren Buffett's Berkshire Hathaway just dropped $5 billion into Google. Now, this isn't just about one stock. This is a classic value player deploying serious capital into mega-cap tech, basically saying they see value where everyone else sees fear. And you can see why. At a forward PE around 25, it's looking pretty attractive compared to its peers.
So, this really brings us to what I'm calling the volatility catalyst wall. This is the main reason for all the defensive positioning we're seeing right now.
The market is basically holding its breath for three huge events packed into a super tight window. Wednesday, 2 p.m. Eastern, we get the FOMC Minutes. Then, after the bell on Wednesday, it's the big one, Nvidia reports. And if that's not enough, Thursday at 8:30 a.m., we get the first jobs report since the government shutdown. This compressed timeline is just cranking up the volatility and forcing everyone's hand.
And you can see that defensive posture perfectly reflected in the VIX. It is holding that critical $18 to $20 support range like a rock. Now, historically, that zone is the floor. If we break below it, that's your signal for risk on. But for now, holding this level means the market is pricing in some serious turbulence from these upcoming catalysts. No doubt about it.
Okay, let's drill down from the macro picture to the key sector battlegrounds. This is where the thesis is actually playing out on the tape.
First up, the S&P 500 ETF, SPY. We've got a technical breakdown. That 138-day streak of holding above the 50-day moving average, it's gone, broken. That is a clear, unambiguous signal of a weakening market structure.
So this is the number that matters right now, 663. That is the critical support battleground for SPY. Write it down.
And make no mistake, what's happening right now is a decisive test. The question is simple. Will buyers defend this level? Because if they fail to hold 663, the door swings wide open for a much faster, high-velocity sell-off.
We're already seeing specific bearish positioning top up across some key sectors. Take a look at regional banks, KBE. We're noting large, bearish options flow coming in there. Over in the semis, Lam Research not only saw a big put trade, but the CFO also dumped $6 million worth of stock. And in tech hardware, someone placed a $1 million bearish bet on short-dated, in-the-money puts on Logitech. That's not a hedge. That signals high conviction for immediate downside.
Now, a quick reminder. This content is for educational purposes only. It's an aggregation of public sources designed to help you stay informed and improve your own decision-making. Please do your own research. This is not financial advice.
And if this analysis was helpful, go ahead and subscribe and turn on notifications for the new weekly market update playlist so you don't miss any of our future weekly recaps. All right, now let's put all of this together. How do we translate this data into actionable scenarios and a clear posture?
Okay, I'm looking at three primary scenarios for the SPY. Our base case is that we're stuck in a choppy range, basically between 663 support and 670 resistance, until these catalysts hit. That means the posture has to be defensive, high cash. Now the bull case gets triggered if we can reclaim 670. The likely driver there would be a weak jobs report that forces the Fed's hand. On the flip side, the bear case activates with a clean break below 663, which would probably be fueled by a strong jobs report that confirms a hawkish Fed.
So let's just break it down into the two core arguments. The bull thesis is basically that this dip is a fear-driven buying opportunity. You get a weak jobs report, the Fed pivots, and Nvidia blows out earnings, sparking a huge relief rally. The bear thesis? It's that the crypto collapse is the canary in the coal mine for a broader risk-off move.
A strong jobs report confirms the hawkish Fed is here to stay, and that technical breakdown in the SPY accelerates once we lose that 663 support. Okay, let's talk about how you could express a thesis using options. And I want to be very clear, these are just educational examples, not recommendations. Two potential bearish setups are on the radar based on this data. First, in regional banks, KBE. The thesis here is based on that technical weakness and the bearish flow we've seen. A structure like a put-debit spread could make sense because it defines your risk while letting you play for a downward move. Second, Lam Research, LRCX. Here, the thesis is really driven by that combination of insider selling and unusual options activity. A straight long put targeting a break of the recent lows could be a way to structure that idea.
Now, a critical warning before we close: trading options involves substantial risk. Your capital is at risk, and losses can, and often do, exceed the premium paid. These are absolutely not trade recommendations.
If this market brief helped you prepare for the session, go ahead and like and subscribe. And make sure to turn on alerts so you don't miss the next one.
And to be perfectly clear, this is not trading advice. It's a market update to help keep you informed. All markets carry risk. Always trade your own plan, manage your downside, and be sure to verify all data independently.